You mentioned the other day, just in passing, about how the cash flow boost is taxed differently, which I had no idea about. And I think it's important that people understand what that means, because obviously it's tax time. A lot of people are taking a boost. So what does that mean?
Yeah, look, I'll pre-disclaimer this one that it's a hotly debated topic in the accounting ranks at the moment. So I'll kind of touch on it and then say, do some research and ask some questions to your accountant. So even in the last year or so, so ATO cash boost was the basically the offset or the extra income that the ATO gave business owners that employed employees. So if you paid enough employees, you got a $50,000 boost and then another $50,000 boost that stopped you from paying the income tax withheld on your employees' wages. So it gave your company or trust or individual up to $100,000 cash boost. So that's the ATO cash boost. Now, what's happened over the last since March? That kicked in March 2020. It was paid up until the first quarter, the July-September quarter in the 2021 financial year. Now, the initial scenarios that, you could look on the ATO and it would say you had to include the cash flow boost on your tax return as income, then you'd wipe it out as exempt income, so you'd take it back out. Then people said, no, it's not a non-assessable, non-exempt income called NANE, N-A-N-E. So don't show it at all. Don't put it on there. Just disregard it. And then it kind of got all confused. And then even you guys have probably seen on profit and loss of profit and losses you guys have been handed. You'll see ATO cash boost on the profit and loss.
Mm-hmm.
So there's been these new kind of rulings come out that say, no, it's equity basically for the company. It's $100,000 and it should be shown in the equity section of the balance sheet. It should never have been shown as income. And it's a retained earning that should stay in a company. Now, if the business owner then decided to take that $100,000 cash boost out, it's not possible to pay tax on that money. So you don't get franking credits. So when you take that $100,000 out, let's say, Nick, you're in the highest tax bracket as an example, you're paying tax at 45 cents to the dollar, and we declare a dividend out of your company, but you want to take that 100 grand, it's going to be an unfranked dividend and you're going to owe the ATO $45,000 back for taking that out of your company rather than leaving it there as a retained earning. Big one that's not often discussed and not often understood and still being understood by a lot of accountants and a lot of business owners out there. And it's, again, different treatment in a trust. You've got to kind of do special resolution and distribution minutes on how that comes out. But yeah, one to be wary of, the ATO cash flow boost, how that's treated for companies, trusts, and individuals, and what that means to your balance sheet and retained earnings if you are a company. So one to check out.